The stability of the global financial system rests heavily on the U.S. Treasury market, and right now that foundation is under visible strain. Japan, the largest foreign holder of U.S. government debt, is accelerating its retreat at a moment when U.S. borrowing needs are rising and liquidity is already fragile. This is not a symbolic move or a distant risk. It directly affects interest rates, currency stability, and the cost of capital across the world. When a key buyer steps back, yields do not just adjust gradually, they can gap higher, forcing rapid repricing across equities, credit, and housing. Markets are beginning to recognize that this shift is structural, not temporary. What appears to be a localized policy adjustment is exposing deeper vulnerabilities in how U.S. debt is financed, priced, and trusted right now. Japan's domestic monetary shift is forcing a structural reduction in U.S. Treasury demand, and this development carries strategic significance that extends well beyond bilateral financial flows. The importance of this shift lies in timing and scale. Japan has long been one of the largest foreign holders of U.S. government debt, not as a speculative participant, but as a structurally committed allocator driven by yield differentials, currency stability, and regulatory frameworks. That role provided the U.S. Treasury market with a steady, relatively insensitive source of demand that helped suppress volatility and absorb rising issuance during periods of fiscal expansion. As Japan recalibrates its monetary stance, that stabilizing function is weakening at a moment when global financial conditions are already tightening and geopolitical fragmentation is accelerating. The global economy is entering a phase where capital is no longer allocated purely on efficiency and yield, but increasingly on security, domestic resilience, and policy alignment. Within this environment, Japan's shift away from ultra-loose policy is not an isolated adjustment, but part of a broader transition that is exposing structural vulnerabilities in the U.S. funding model. To understand why the current situation is structurally more dangerous, it is necessary to place Japan's role in historical context. For more than 2 decades, Japan operated under an extraordinary monetary regime defined by zero interest rates, quantitative easing, and yield curve control. These policies compressed domestic yields to such an extent that Japanese institutional investors were effectively pushed abroad in search of returns. U.S. Treasuries became a natural destination due to their depth, liquidity, and perceived safety, even after accounting for currency hedging costs. This dynamic was particularly pronounced after the global financial crisis, when synchronized monetary easing reinforced cross-border capital flows into U.S. assets. Previous episodes of reduced foreign treasury demand, such as during the late 1990s or the early stages of the 2000s, occurred in environments where global savings gluts or disinflationary forces provided alternative buffers. The current moment differs because it combines elevated global debt levels, persistent inflation pressures, and geopolitical tension that constrains policy coordination. Japan's exit from ultra-loose policy is unfolding alongside rising fiscal needs in the United States, making the withdrawal of Japanese demand far more consequential than in earlier cycles. The mechanism through which this shift operates is rooted in relative yield dynamics, currency risk, and balance sheet constraints. As the Bank of Japan allows domestic yields to rise, Japanese government bonds become competitive again for domestic institutions. When adjusted for duration risk and regulatory capital treatment, domestic bonds now offer a more attractive risk-adjusted profile than foreign alternatives. At the same time, currency hedging costs for holding U.S. Treasuries have increased as interest rate differentials narrowed and volatility in foreign exchange markets rose. For pension funds and insurers, whose liabilities are denominated in yen, unhedged exposure to dollar assets introduces unacceptable balance sheet risk. Hedging that exposure, however, erodes much of the yield advantage that once justified holding U.S. debt. Banks face similar pressures as regulatory frameworks increasingly emphasize domestic liquidity buffers and stable funding ratios. These are not discretionary decisions, but structural responses to changes in monetary conditions, regulatory expectations, and asset liability matching requirements. This reallocation process unfolds gradually but persistently. Japanese institutions do not need to sell treasuries aggressively to reduce exposure. Even a reduction in reinvestment flows materially alters demand dynamics. As bonds mature and proceeds are redirected toward domestic assets, the cumulative effect is a steady erosion of foreign sponsorship for U.S. debt. This matters because the U.S. Treasury market relies on continuous absorption of new issuance to finance deficits that remain historically large. Without price-insensitive buyers, yields become more responsive to supply imbalances, macroeconomic data surprises, and shifts in risk sentiment. The market transitions from a regime of managed stability to one of heightened sensitivity, where marginal changes in demand exert outsized effects on pricing. Financial markets have begun to register this change through increased volatility and altered pricing behavior. U.S. Treasury yields now react more sharply to auction results, inflation data, and policy signals than they did during the period of heavy foreign participation. The yield curve exhibits episodic instability as term premiums adjust upward to compensate for diminished structural demand. Equity markets, particularly interest rate-sensitive sectors, reflect this adjustment as higher yields tighten financial conditions and weigh on valuations. Currency markets also respond, as shifts in Japanese capital allocation influence dollar-yen dynamics and global liquidity conditions. Institutional investors interpret these signals as evidence that the Treasury market is losing some of its traditional shock-absorbing capacity. Markets react before public narratives change because participants with exposure to funding costs, leverage, and duration risk must adjust positioning proactively rather than wait for confirmation in official statements. The constraints facing governments and central banks complicate the response. U.S. policymakers cannot easily offset the loss of foreign demand without accepting higher yields or increasing domestic financial repression. Expanding central bank purchases risks undermining inflation credibility, while pressuring domestic institutions to absorb more debt tightens financial conditions elsewhere in the economy. Fiscal adjustment remains politically constrained, particularly in an environment of polarized governance and rising entitlement obligations. For Japan, reversing the domestic monetary shift is equally problematic. Maintaining ultraloose policy in the face of rising inflation and currency pressure would undermine domestic stability and erode confidence in the central bank. Policymakers on both sides face trade-offs that limit their ability to restore the previous equilibrium, making the current adjustment path difficult to arrest once underway. The global spillover effects of this shift extend across regions. In the United States, higher Treasury yields translate into increased borrowing costs for households, corporations, and the government, reinforcing fiscal strain and tightening financial conditions. China observes these developments with strategic interest, as reduced foreign participation in U.S. debt aligns with broader efforts to diversify reserves and reduce reliance on dollar assets. Russia and other BRICS economies view the fragmentation of global capital flows as confirmation that financial interdependence carries strategic risk, accelerating moves toward alternative settlement systems and reserve compositions. Europe faces indirect pressure as global yield repricing affects sovereign spreads and complicates monetary normalization. Emerging markets experience heightened volatility as shifts in U.S. yields influence capital flows, exchange rates, and debt servicing costs, often amplifying existing vulnerabilities. As this process unfolds, escalation paths and feedback loops emerge. Higher U.S. yields increase fiscal deficits through higher interest expense, necessitating greater issuance that further pressures demand. Market volatility feeds into risk management models, prompting investors to shorten duration or reduce exposure, which amplifies yield movements. Currency fluctuations driven by Japanese capital repatriation affect trade balances and corporate earnings, reinforcing defensive behavior among firms and investors. External shocks, such as geopolitical crises or commodity price spikes, could accelerate this adjustment by triggering sudden shifts in risk appetite and capital allocation. The interaction of these forces creates a self-reinforcing cycle in which reduced demand begets higher volatility, which in turn discourages long-term participation. Looking toward 2025 and 2026, the trajectory suggests a structural rather than cyclical adjustment. In the short term, Treasury markets are likely to remain volatile as they adapt to a new demand profile. Medium-term consequences include a higher equilibrium level for yields, increased importance of domestic absorption, and greater sensitivity to fiscal policy credibility. Over time, this reshapes the architecture of global finance by weakening assumptions that large deficits can be financed indefinitely without consequence as long as the dollar remains dominant. The redistribution of capital toward domestic priorities in major economies signals a gradual erosion of the post-crisis financial order, where cross-border flows smoothed imbalances and dampened volatility. In analytical conclusion, Japan's domestic monetary shift represents a quiet but profound change in the structure of global demand for U.S. Treasuries. The reduction in Japanese participation is not a transient market reaction, but a balance sheet-driven realignment that reflects deeper changes in monetary policy, regulation, and risk perception. Its implications extend beyond yields and currency movements, touching the core assumptions that have underpinned global financial stability for decades. As this adjustment continues, policymakers and market participants alike must contend with a world in which financial buffers are thinner, volatility is more persistent, and the margin for error is narrower. The situation warrants close monitoring not because it signals imminent crisis, but because it reveals a structural shift that will shape global economic dynamics in the years ahead. The U.S. Treasury market is struggling to absorb supply without its traditional backstop, and this challenge has become strategically critical at the current juncture of the global economic cycle. The United States is simultaneously confronting large structural deficits, elevated refinancing needs, and a geopolitical environment that discourages automatic foreign participation in its debt markets. For decades, the Treasury market's resilience rested on a layered demand structure that included foreign central banks, sovereign institutions, and large international asset managers willing to hold U.S. government debt regardless of short-term price movements. That foundation is now eroding. As Japan and other historically reliable holders reduce their exposure, the burden of absorption shifts toward domestic investors and marginal buyers, whose participation is conditional on price, yield, and volatility. This transition is occurring at a time when global liquidity is tightening rather than expanding, making the adjustment far more destabilizing than it would have been in an era of synchronized monetary accommodation. The broader global environment magnifies this vulnerability. The post-pandemic period has been marked by persistent inflation pressures, aggressive monetary tightening, and rising political constraints on fiscal consolidation. At the same time, geopolitical fragmentation has weakened the assumption that global savings will naturally recycle into U.S. assets during periods of stress. Instead of acting as a universal safe haven with unlimited demand, U.S. Treasuries are increasingly treated as one asset among many, subject to balance sheet constraints and relative value comparisons. This represents a fundamental shift in how global capital allocates risk, and it places the Treasury market at the center of a complex adjustment process that has direct implications for financial stability. Historically, the U.S. Treasury market has faced periods of heavy issuance before, but the surrounding conditions were materially different. During the 1980s and 1990s, expanding deficits were absorbed in part by growing global appetite for dollar-denominated assets as globalization accelerated. In the aftermath of the 2008 financial crisis, massive issuance was offset by aggressive central bank purchases and a surge in foreign reserve accumulation. Even during the pandemic, when issuance reached extraordinary levels, coordinated monetary easing ensured that demand kept pace with supply. The current episode stands apart because issuance is rising into an environment of quantitative tightening, balance sheet normalization, and diminished foreign sponsorship. Policy failures of the past were often cushioned by excess global liquidity or deflationary forces. Today, those buffers are absent, making the system far less forgiving. The structural danger lies in the interaction between supply growth and demand composition. U.S. debt issuance is not only large in absolute terms but also persistent, driven by demographic pressures, entitlement obligations, and rising interest costs that compound deficits. Unlike earlier cycles, there is limited political consensus around fiscal restraint, and the path of least resistance remains continued borrowing. At the same time, traditional foreign buyers are reassessing exposure due to domestic monetary shifts, currency considerations, and geopolitical risk. This creates a scenario in which the Treasury market must clear at higher yields to attract sufficient demand, introducing feedback loops that were less pronounced in previous decades. The mechanics of this adjustment are rooted in how supply is distributed and absorbed. Treasury issuance spans maturities, but longer-dated bonds are particularly sensitive to demand shifts because they carry greater duration risk. When foreign central banks and reserve managers were active buyers, they absorbed duration without demanding a large risk premium. As that participation wanes, duration risk must be held. D by investors who are more sensitive to mark-to-market volatility, funding costs, and regulatory constraints. Primary dealers, asset managers, hedge funds, and domestic institutions can fill this role only if compensated with higher yields. This repricing is not speculative. It reflects the cost of balance sheet usage, capital requirements, and liquidity risk in a world where central bank backstops are less expansive. Debt rollover amplifies these pressures. A significant portion of U.S. debt matures each year and must be refinanced at prevailing rates. As yields rise, interest expense increases, feeding directly into future deficits and necessitating even more issuance. This dynamic tightens the link between fiscal policy and market conditions, reducing the margin for error. Inflation expectations and growth prospects still matter, but they no longer dominate pricing in isolation. Supply-demand imbalances exert a growing influence, especially during auction cycles when market depth is tested. Market behavior increasingly reflects these underlying strains. Treasury auctions have shown greater sensitivity to weak bid-to-cover ratios, tailing yields, and reduced indirect bidding. Yield volatility has increased even in the absence of major macroeconomic surprises, signaling that liquidity is thinner than headline metrics suggest. Equity markets respond to these movements because higher yields tighten financial conditions and pressure valuations, particularly in sectors reliant on cheap financing. Currency markets also react, as rising U.S. yields attract short-term capital while increasing hedging costs for foreign investors, reinforcing the retreat of long-term buyers. Institutional investors interpret these signals as evidence that the Treasury market is transitioning from a stability anchor to a source of volatility. Asset managers adjust portfolio construction by shortening duration or demanding higher term premiums. Banks face constraints due to regulatory capital requirements that limit their ability to warehouse additional government debt. Hedge funds may step in tactically, but their participation is inherently pro-cyclical and dependent on funding conditions. This changes the character of demand from stable and countercyclical to conditional and potentially destabilizing. Government and central bank constraints further complicate the situation. The Federal Reserve is constrained by its inflation mandate and cannot easily resume large-scale asset purchases without undermining credibility. Fiscal authorities face political resistance to austerity and limited appetite for structural reform. Coordination between monetary and fiscal policy is politically sensitive, especially in an environment of heightened scrutiny over central bank independence. Measures that might stabilize the market in the short term carry long-term costs that policymakers are reluctant to accept. As a result, the adjustment is left largely to the market, increasing the risk of disorderly moves. The global spillover effects of a strained Treasury market are significant. In the United States, higher yields affect mortgage rates, corporate borrowing, and government financing costs, slowing economic momentum. China observes these developments through the lens of strategic competition, accelerating diversification away from dollar assets while managing its own financial vulnerabilities. Russia and other BRICS economies interpret reduced Treasury stability as validation of efforts to build alternative financial arrangements, even if those systems remain incomplete. Europe faces indirect pressure as global yields reprice, complicating sovereign financing and monetary normalization. Emerging markets are particularly exposed, as higher U.S. yields tighten global financial conditions, trigger capital outflows, and raise debt servicing burdens. Escalation paths emerge when these forces interact. A spike in yields can trigger risk-off behavior, reducing liquidity and exacerbating price movements. Higher interest costs worsen fiscal projections, prompting further issuance that the market struggles to absorb. Currency volatility feeds back into foreign investor behavior, reinforcing the withdrawal of long-term capital. External shocks, whether geopolitical or economic, can act as catalysts that accelerate these dynamics, transforming gradual adjustment into abrupt stress. Looking ahead to 2025 and 2026, the outlook suggests a prolonged period of adaptation rather than a swift resolution. In the short term, volatility is likely to remain elevated as markets test the limits of demand. Medium-term consequences include a higher structural cost of capital for the United States and increased reliance on domestic absorption. Over time, this reshapes the global financial architecture by weakening assumptions about the infinite capacity of the Treasury market to act as a universal buffer. The balance of power in global finance shifts subtly as capital becomes means more selective and politically contingent. In analytical conclusion, the difficulty the U.S. Treasury market faces in absorbing supply without its traditional backstop reflects a deeper structural transition rather than a temporary dislocation. The erosion of stable foreign demand exposes the market to forces that were previously muted, increasing sensitivity to issuance, policy credibility, and global risk sentiment. This development does not signal imminent crisis, but it does indicate a narrowing margin for error in the world's most important sovereign debt market. As this adjustment unfolds, it will shape financial conditions, policy choices, and global economic stability well beyond the immediate horizon, warranting sustained attention from policymakers and market participants alike. The rise in U.S. Treasury yields is no longer a localized adjustment within the American bond market, but a transmission mechanism exporting financial stress across global asset classes. This development is critically important now because U.S. Treasuries function as the foundational pricing reference for the modern financial system. They are not simply another asset class. They anchor discount rates, collateral valuations, risk models, and funding assumptions worldwide. When Treasury yields rise sharply due to shifts in demand and market structure rather than improved growth prospects, the tightening effect on financial conditions is both abrupt and indiscriminate. This shift is unfolding at a moment when global leverage remains elevated, fiscal balances are strained, and monetary authorities have limited room to maneuver. As a result, the increase in yields is not being absorbed smoothly. Instead, it is propagating through equities, credit, currencies, and capital flows in ways that amplify fragility rather than restore equilibrium. The global context makes this transmission more dangerous than in previous cycles. For much of the post-financial crisis period, low and stable Treasury yields suppressed volatility and encouraged risk-taking across borders. Asset valuations, portfolio strategies, and even government financing plans were built on the assumption that the U.S. risk-free rate would remain structurally low and predictable. That assumption is now being dismantled. The current rise in yields is occurring alongside geopolitical fragmentation, reduced cross-border trust, and a reassessment of dollar-centric financial dependence. In this environment, higher yields do not signal healthy normalization. They signal a withdrawal of stabilizing demand and a repricing of risk that is occurring faster than balance sheets can adjust. Historically, periods of rising Treasury yields have had different implications depending on the underlying cause. When yields rose in response to strong growth expectations, markets often absorbed the change with limited disruption. Equity earnings improved, credit risk declined, and higher yields were offset by stronger cash flows. By contrast, when yields rose due to supply pressures, policy missteps, or demand erosion, the impact was far more destabilizing. Episodes such as the 1994 bond market sell-off, the 2013 taper tantrum, and the 2018 tightening cycle demonstrate how yield increases driven by financial conditions rather than growth can trigger widespread volatility. What distinguishes the current episode is the scale of global leverage and the central role Treasuries play in collateral and funding markets. The system is more interconnected, more debt-dependent, and more sensitive to changes in the risk-free rate than at any prior point. The structural danger today lies in the mechanical nature of repricing. Treasury yields feed directly into valuation models through discount rates. When yields rise, the present value of future cash flows declines, compressing equity valuations even if earnings expectations remain unchanged. This effect is particularly pronounced in sectors with long-duration cash flows, such as technology, infrastructure, and real estate. At the same time, higher yields raise corporate borrowing costs, affecting both new issuance and refinancing. Firms that relied on cheap debt to sustain margins or fund expansion face immediate pressure, regardless of their operational performance. This is not a discretionary market reaction. It is a mathematical adjustment embedded in financial models and contractual obligations. Credit markets feel this stress acutely. Spreads widen not necessarily because default risk has spiked, but because the baseline risk-free rate has moved higher and liquidity conditions have tightened. Leveraged loans, high-yield bonds, and private credit structures become more vulnerable as refinancing windows narrow. Lenders reassess risk tolerance, and borrowers confront higher interest expenses that erode profitability. Even investment-grade issuers are affected, as higher yields change capital allocation decisions and reduce appetite for long duration. Exposure. The result is a broad tightening of financial conditions that extends well beyond the Treasury market itself. Emerging markets experience an even more direct transmission channel. Higher U.S. yields attract global capital back toward dollar assets, reducing the relative appeal of emerging market debt and equities. This leads to capital outflows, currency depreciation, and higher local interest rates as policymakers attempt to stabilize exchange rates. Countries with large external financing needs or dollar-denominated debt are particularly exposed. Even those with sound fundamentals face pressure as global investors reduce risk across the board. This dynamic mirrors previous episodes but is intensified by the scale of global debt and the diminished willingness of advanced economy central banks to provide external liquidity support. Currency markets amplify these effects. Rising U.S. yields alter carry trade dynamics, increasing hedging costs and forcing investors to unwind positions. Volatility rises as exchange rates adjust to new interest rate differentials. For multinational firms, this creates earnings uncertainty and complicates financial planning. For sovereigns, it increases the cost of servicing foreign debt and managing reserves. These currency adjustments are not speculative swings. They reflect fundamental changes in funding costs and capital allocation incentives driven by the Treasury market. Institutional investors interpret these signals as evidence that the global risk-free anchor is becoming less stable. Portfolio construction strategies that relied on treasuries as a hedge against equity risk are being reevaluated as correlations shift. When treasuries lose their stabilizing role, diversification benefits diminish, forcing investors to demand higher risk premiums across assets. This repricing feeds back into market volatility, reinforcing the initial stress caused by rising yields. Markets react ahead of public narratives because these mechanisms are embedded in real-time risk management systems and margin requirements. Government and central bank constraints exacerbate the situation. Policymakers cannot easily offset the tightening without undermining credibility. Central banks remain constrained by inflation concerns and political scrutiny, limiting their willingness to intervene aggressively. Fiscal authorities face rising debt servicing costs that restrict countercyclical spending. Attempts to stabilize one market risk destabilizing another, creating policy trade-offs that were less severe in earlier cycles. As a result, much of the adjustment is left to market forces, increasing the likelihood of overshooting and abrupt repricing. The global spillover effects are increasingly visible. In the United States, higher yields tighten domestic financial conditions, affecting housing, corporate investment, and consumer credit. In China, rising U.S. yields complicate capital flow management and reinforce incentives to reduce exposure to dollar assets. Russia and other BRICS economies view treasury instability as confirmation of the risks associated with dollar dependence, accelerating efforts to develop alternative financial arrangements. Europe faces imported tightening as global yields rise, complicating monetary policy and sovereign financing. Emerging markets bear the brunt of volatility, as capital flows become more selective and risk-averse. Escalation paths emerge through feedback loops. Higher yields weaken asset prices, which tighten financial conditions, slowing growth and increasing credit risk. Slower growth undermines fiscal projections, leading to more borrowing and further upward pressure on yields. Currency volatility feeds back into capital flows, reinforcing stress in vulnerable markets. External shocks, whether geopolitical or economic, can accelerate these dynamics by triggering risk-off behavior that overwhelms market liquidity. Looking toward 2025 and 2026, the forward outlook suggests that elevated treasury yields will remain a persistent source of global stress rather than a temporary disturbance. In the short term, volatility is likely to remain high as markets adjust to a new equilibrium. Over the medium term, higher structural yields imply lower asset valuations, tighter financial conditions, and increased differentiation between resilient and fragile economies. The global financial architecture evolves toward greater fragmentation, with risk pricing reflecting geopolitical and structural considerations alongside traditional economic metrics. In analytical conclusion, higher treasury yields are functioning as a powerful transmission channel for financial stress across global markets. Because U.S. treasuries anchor the valuation and funding of the global system, instability in this market reverberates widely and mechanically. The current rise in yields, driven by demand erosion rather than growth strength, tightens conditions even in economies with stable FU. Fundamentals. This dynamic does not signal imminent collapse, but it does indicate a more fragile and reactive financial environment in which shocks propagate faster and buffers are thinner. Understanding this transmission is essential for assessing global stability as the system adapts to a new era of constrained liquidity and heightened structural risk. Confidence risk is emerging as a central fault line in the U.S. Treasury market, as instruments long regarded as the global safe haven increasingly behave as a source of volatility rather than stability. For decades, Treasuries derived their unique status from a combination of unparalleled liquidity, consistent foreign official demand, and the assumption that in moments of stress capital would flow toward, not away from, U.S. government debt. That assumption is now being tested in real time. As large structural holders reduce exposure and market depth thins, price movements in treasuries have become sharper and less predictable, undermining their traditional role as shock absorbers within global portfolios. This shift matters because the perception of safety is as important as legal creditworthiness. Treasuries are still backed by the full fiscal capacity of the United States, but confidence in an asset class also depends on market behavior under stress. When yields spike during periods of uncertainty instead of falling, investors are forced to reconsider core portfolio construction assumptions. Risk parity strategies, liability-driven investment frameworks, and central bank reserve management models all rely on treasuries providing ballast during volatility. As that behavior weakens, the entire architecture of defensive allocation is disrupted. The resulting dynamic creates a self-reinforcing feedback loop. As investors observe higher volatility and weaker hedging performance, they demand additional compensation in the form of higher term premiums. Those higher premiums push yields upward even in the absence of worsening fiscal fundamentals, which in turn reinforces volatility and erodes confidence further. This is not a panic-driven phenomenon, but a rational reassessment of liquidity and demand conditions. Markets are pricing not default risk, but confidence risk, reflecting uncertainty about who will consistently absorb supply during periods of stress. While the dollar's reserve currency status remains intact, this episode underscores a critical distinction between monetary dominance and funding stability. Reserve status does not guarantee immunity from market-driven repricing when balance sheet constraints and buyer composition change. Global investors are adjusting to a financial environment in which even core sovereign debt can transmit stress rather than contain it. This adjustment marks a subtle but consequential shift in how risk is understood, priced, and managed as the system moves into the next phase of the global cycle.